The Feds just did their largest increase in decades, but what does that mean for the housing market? That's what we're going to look at on today's episode. Hi, I'm Josh Alexander from the Brokerage and your host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So like I just said, we're going to be taking a look at how the Fed increasing their rates is impacting the housing market and what ultimately that means for both buyers and sellers. So let's go ahead and get into it. So it was just announced this week that the Fed is going to be raising their rates by 0.75%, which is a huge increase. That type of increase hasn't happened since the 90s. So needless to say, it is definitely not normal. But how does that impact the housing market? Well, the easy answer is it actually doesn't. So there's no direct tie on the Fed raising their rate to what mortgage rates are doing. If the Fed raises the rate by 0.75, mortgage rates then all of a sudden don't jump by 0.75%. That's just not how it works. When the Fed raises their rates, it tends to impact short-term interest rates a lot more significantly and a lot more directly. So things like your credit card, car loans, those type of things you're going to see a more direct correlation with. However, with long-term rates, i.e. mortgages, you don't usually see that one-to-one impact. However, mortgage rates have also been skyrocketing over the last week. So what's going on? Well, it actually has less to do with the Fed raising their rate and more to do with why they raised their rate. So the reason why they're getting more aggressive with the rate increases is because last week we got a bad CPI report, Consumer Price Index, and that shows how much inflation we're going to have. So it came in much higher than expected, and because of that, the Fed decided to raise their rate higher than they were expecting to as well. But inflation is going to be a much bigger driver to long-term interest rates than what the Fed is doing. So because inflation came in so high, that's when you saw mortgage rates skyrocket as soon as we got those numbers in. And I've said this before in the channel, but inflation is the enemy of long-term interest rates. So every time we get any type of bad news surrounding inflation, you're going to need to expect mortgage rates to continue to climb. Which means until we get inflation under control, you can expect mortgage rates to most likely continue to rise until we start seeing inflation go back down and start receding a little bit. So that's currently where we are in the housing market. Now, just since the beginning of June, interest rates have gone from 5.47 all the way up to 6.22. Yes, you heard me correctly. Interest rates for an average 30-year fixed mortgage are now above 6%, which is almost unthinkable at the beginning of this year. We started this year with interest rates at 3.27%, and they've gone all the way up to 6.22. That's almost a 3% increase, and that's the largest and fastest increase that we've seen in any recent history in the housing market. So how is this actually impacting the housing market? Let's go ahead and take a look. So let's start by looking at just this last month alone. So at the beginning of June, interest rates were hovering right around that 5.47%. Today, they're at 6.22. So let's see the actual number breakdown. So if you're trying to buy a $1 million home back at the beginning of this month, which was only 2 weeks ago, your payment with just principal and interest was going to be right around $4,500. However, at 6.22%, you're now looking at payments around $4,900, which means that the average payment for you has gone up by $400 a month in just 2 weeks. That's a huge difference and really is impacting the amount of buyers willing to purchase homes right now. And if you want to look at this in a different perspective, let's say that you were trying to buy that $1 million property at the beginning of this month and that payment was right around $4,500. If you wanted to keep your payment around that same $4,500 in today's market, you're now looking at homes around $925,000. So you just lost $75,000 of purchasing power in about 2 weeks. That's a huge difference in the housing market, and those type of shifts we don't see happen that often. Now, if you take this out even further, let's look at the beginning of the year when interest rates were hovering right around that 3.27%. If you were trying to buy a $1 million property at that 3.27% at the beginning of the year, your payments would only be averaging right around that $3,500 mark. Now again, compare that to today where you're paying $4,900 on average. That's a $1,400 a month difference just since the beginning of the year. So you can see why homes are starting to become less and less affordable for more and more buyers. So let's break this down just one more time in a different way, just again to show you how much your affordability has been impacted over the last 6 months in the housing market. If you are trying to keep your payment at the $4,900 mark, which again will be buying you $1 million property today, if you had that same budget at the beginning of the year, you could have been looking at properties that were $1.4 million or $400,000 more than what you can afford today for that same payment. So needless to say, this is why we're seeing such a dramatic shift in the housing market, because these interest rates have really impacted affordability and very quickly at the same time. So people are still getting used to this. A lot of sellers still think we're in a hot seller's market where you can put it on there at a premium price and it's gonna sell in a week. That's just not the case anymore. We are no longer in that hot seller's market that was just here just 2 or 3 months ago. We are quickly making our way to a slight seller's market. And you can see that in the average days on market. The average days on market right now is approaching 50 days, which means from the day you put your sign in the front yard to the day you get into escrow, it's taking more than a month and a half at this point on average in Orange County to be able to get a home in escrow. So if you're a seller and you're expecting to get multiple offers that first weekend, yes, it's still happening in some places. If you have that HDTV ready home, everything's perfect, then a lot of times you can still get multiple offers the first weekend. But for more and more sellers every single week, they're getting a wake-up call because they're not getting offers the first weekend. They're not getting offers the second weekend. It's taking 3, 4, 5 weeks for them to get the right offer for them to get into escrow right now. So if you're a seller in today's market, you need to understand the market has shifted. We are no longer in that hot seller's market that we were just a few months ago. You have to understand the circumstances. If you overprice your home, it is just going to sit there and you're going to eventually have to do a price reduction, which it's been shown time and time again that anyone doing price reduction is going to have a much higher chance of getting a lower price for the home than they would have if they just priced it within the market value range to begin with, which is fair market value, and waited for buyers to come to them. So as a seller, you need to know what type of market we're in because it's shifting every single week. So you have to understand that in the next couple weeks, we're gonna be in less of a seller's market than we currently are right now. Now, are we gonna be in a buyer's market anytime soon? No, we still have a long ways to go. Inventory is just way too low. Even though demand is low, inventory is still much lower than it needs to be to satisfy the demand of the current buyers out there. However, we are transitioning right now from a hot seller's market that we were in spring into a slight seller's market, which means that appreciation is slowing to a crawl. It's still happening, but it's happening at a much more normal and healthy pace at this point, and sellers need to understand that before they place their house on the market. So buyers, what does this actually mean for you? So yes, we are transitioning out of the hottest seller's market that we have ever seen and the hardest time ever for buyers to purchase a home. However, the reason why we're transitioning out of that is because interest rates have climbed so high and affordability has gone down. So really my best advice for you is that you need to understand that you need to be thinking for the long term. So if you're trying to purchase a home right now, you need to concentrate on those monthly payments. If you're planning on staying in the home for at least 5 years, you want to look at those monthly payments and see if you can afford them and if your family's going to be able to do so financially and it's going to be able to get you into the area, the neighborhood, and the type of house you want. It's still a good time to buy. And like I said before, if interest rates drop, you can always refinance later, but appreciation is still happening week by week and month by month. Yes, it's starting to finally slow down, which is good news for you. However, it is continuing to happen. So if you sit on the sidelines for too much longer, homes are still going up in value. And until we get inflation under control, you're going to see interest rates continue to climb as well. And waiting is just not a strategy I would recommend right now because we are still nowhere close to a buyer's market. Even if we transition from a hot seller's market to a slight seller's market, we still have to get into a balanced market and then finally a slight buyer's market before you see home prices start coming down. And that is just not going to happen anytime soon. Inventory is just way too low right now and demand is still high enough to be able to eat up all these homes that are hitting the market, even as interest rates continue to climb. So if you're waiting to purchase, just know that appreciation is still happening and interest rates are still climbing until we start getting inflation under control. Now, the one positive thing I do have to say for buyers is you're no longer having to pay a significant amount over the actual value of the home to be able to get into escrow. You have more time on your hands to go check out homes because they're not flying off the market within the first week anymore, so you have more time to check them them out, make a decision, place an offer. It still needs to be aggressive, but nowhere near as aggressive as they used to be just a few months ago. So you can keep a lot more of your contingencies in place, keeping yourself more protected during the transaction, and you're not having to place ridiculous offers way over asking price to be even considered like you would have just a few months ago. So know that yes, it is going to be tough to buy a home because of affordability. However, when you start placing offers, there's a lot less competition and a lot more places to choose from, because as we head through summer, inventory is going to continue to climb every single week, putting us farther into a slight seller's market and giving you more opportunity to find the best place for you and your family. So once again, if you are finding this content useful, please don't forget to hit that subscribe, follow, and that share button below. And if you're watching this on YouTube, don't forget to hit that bell button as well. That way you're notified every single week when I release a new episode. So until next time, stay healthy, stay happy, and I'll see you on the next show. Bye.